Stocks are trading down with more fear, than we've ever witnessed. And I think a lot of the volatility is simultaneously dealing with two issues. I mean, the first is really just financial. This idea that that one's income is being reduced in some way, or their net worths are being decimated in many cases, particularly for those more leveraged. And as if that doesn't create enough stress, we are all living with this existential risk as we come face to face with our own mortality. And we've never collectively, certainly in the U.S., faced these two together. And although it's been the case in some other countries, but the two together has created this emotion squared and with an unprecedented negative feedback loop: lost jobs, lost income, fear of dying yourself or losing a family member or a friend. As most of us all twisted up. But if one thinks more calmly about what the longer term impact might be, it's hard to not want to be invested, because one day people will again be flying in planes, staying in hotels, eating in restaurants, etc. And the way governments are printing and borrowing money, it's hard to imagine we won't have inflation at some point. So approach remains the same, but there's certainly been, we'll dive into this later as we go through the call, there certainly has been portfolio changes as a result of what's transpired.
And do you have a high level view on what the impact of the virus and the actions that have been taken by politicians or government central banks around the world? Do you have a high level view on its impact on GDP and then perhaps on corporate earnings as well?
Yeah, I'm going to give you only the highest level of view, because that has never been our expertise, but we're clearly in a global recession. I mean, the expectation, has just been doubled for the decline in GDP in the U.S. Just came out 10 minutes ago in the second quarter, almost doubled. From 6% was the expectation from the contraction to 10% plus. So, but how deep we're clearly in a global recession. How deep it will be will depend on part on how long businesses remain halted, and combined with the kind of stimulus packages that come out. And how long those businesses will be halted will be a function of how this disease runs its course, not just this first wave, but if in the event that there is a second wave. So if you go look at the Spanish flu pandemic of 1918, there were 3 waves to it. So I don't know how this plays out, honestly. Most companies are going to be reporting much lower earnings this year, with many reporting losses. But I think the bigger question is, what does the world economy look 1 to 3 years out? We think that people are going to be, as I said just a moment ago, flying in planes, eating in restaurants, staying in hotels, and probably buying something other than toilet paper, at least in the U.S. This can certainly get worse over the short term, particularly as tests become more widely available. I mean, you guys are in South Africa are earlier in the ramp than we are in the U.S., and we're all behind where Italy is in that ramp. We're clearly seeing this ramp in confirmed COVID cases, but it can also get better over the short term as well. As a result of quarantining, and we're beginning to see some of those benefits. I'm a board member at Cedars-Sinai Medical Center in LA, and it's one of the significant medical institutions in the city. At our meeting yesterday, their best projection, with the support of public health officials and the CDC, put peak COVID cases for us here out to May 1. That's 2 to 3 incubation cycles from now. So we expect more bad news over the short term. However, I've also been privy to some incredibly hopeful conversations with scientists in Israel, as I'm also on the board of the Weizmann Institute in Israel. And there's been this search for this therapeutic shorter term and a vaccine longer term, hopes, using computational science, things that didn't exist in these last go-arounds with these kinds of diseases. Computational science, artificial intelligence, machine learning are being used globally in a coordinated open architecture without regard who will get credit, which we've never seen before. So there's this. I don't want to be completely negative about how this is playing out. There's going to be some hopefulness, and when that comes out, that's going to help restart this economy. But it's not going to. People aren't going to be moving back. I mean, in certain cases, there's going to be some V's. Clearly, there's deferred spending, and some things are going to rebound more slowly.
And so, from your statements there, there's been some projections put out by a couple of the central of the investment banks that Q2 will be bad, but we could see a bit of a rebound in Q3, Q4. Do you think that's a bit early then?
No, it could certainly happen. I mean, I think if you don't have this second wave, I think you could see a very, very strong rebound. Then it'll be back to whatever that new normal is. But that could be true. I don't know. I don't want to opine on on the odds of that. I just don't know. Again, we're focusing on where we want to be looking at a few years. And looking at a few years, our companies are going to be, our companies, but the cable companies, they're, Charter Cable is still going to be Charter Cable. That's not going to change.
And so you mentioned in a recent note that you're not seeing any liquidity issues or balance sheet stress in any of the holdings that you have. Has that changed in the last couple of weeks?
Yeah, I would say the calls that we've been having with companies to date are one of encouraging them to draw down on their revolvers and husband liquidity, cut dividends, things like that, just because there is a great level of uncertainty. I think that if an economy goes to a zero revenue environment or a down 90% revenue environment, at some point out, whether that's depending on the company, if it's not sort of sitting cashed up, whether it's 6 months, 9 months, some companies it might be 3 months, they will start to run into issues. Now, that assumes that banks don't do anything, don't kind of string them along, which I think is probably the more likely scenario if companies do run into, obviously COVID-driven liquidity challenges, because again, the industrial base and the productive base of the country is something that I think is going to be important to keep in place. And I think that will be a big focus of support from various governments, right? The recovery will be very difficult to manifest itself if you lose industrial base or productive capacity in the meantime through some type of liquidity crunch. But, to date, the slowdown has really just started here, right? We think most of the country that's gone into quarantine has been over the last 4 or 5 days. And so companies are just starting to see those impacts and are kind of husbanding cash ahead of it.
Speaking more broadly, not just with respect to our portfolio, one of my dear friends is head of the major investment banking and restructuring firm here in the United States called Houlihan Lokey. And since this thing's really ramped here in the U.S., we're really kind of hit this peak realization, at least I would call it, last week here in the U.S. I mean, a very delayed with respect to our population, I would call it a very delayed response. But I call it peak realization last week. From that point, he literally has not been off the phone, including the weekends. It's under his, he's getting fielding restructuring calls nonstop. To Brian's point, I mean, people are pulling down their whatever line they can, and they're figuring out how they get through to the other side, and they're going to not be able to do it without help. They're doing it without competition. Literally, they're just sending out term sheets and they're signing them and faxing them back, immediately, because they're so panicked about what's happening. So this panic that exists is not just happening on the part of shareholders, investors. It's also happening on, with respect to many of these people who are operating these businesses, because nobody's ever seen their business go from 65 to, from 100 to 0. Overnight. That's never happened before to anybody's business. That's just never been in every other past downturn, you've seen some kind of, it might be a steep decline, but it's just it's not hitting the brakes. And we've never lived through this. So we just don't know exactly how that, there's not a playbook for this. I mean, the central bank's actions, have clearly been, swift and strong, and that political leaders are taking the same approach around the world. I mean, George W. Bush went into Iraq with this goal of shock and awe, and political leaders are now taking that same approach into the world, with a different, in a different battle. This is not going to be an immediate economic fix, and it's gonna take time. People have to get out of their homes. Companies have to restart. Some won't. Eventually, the stimulus will begin to work its way through the system, and deferred spending will create some catch-up. I think what the governments are doing, they're going to be forgiving debt, individual debt, forgiving business debt. They're going to be making some equity infusions, I think, I would guess, in essential businesses, certainly bailing out essential businesses, making lots of new small business loans in the U.S. Whatever it takes is what's going to happen. And I think what that virtually guarantees over time, but with this, this deflationary stopgap along the way, I think it guarantees inflation at some point, and it also assures, I think, relatively low rates for the rest of my lifetime. I see no other way for governments to finance their debts. And that in and of itself over time is a good setup for stocks. what else are you going to own? Low yielding bonds? I mean, stocks should provide a reasonable, at least nominal yield over time. And as painful as this is, we need to remember that. And that's what we are trying to do as we come into work every day. We want the kind of portfolio that if we're to take a nap for the next few years, we'll feel pretty good when we wake up.
And Steve, I'll come back to your comments on smaller business and corporates being somewhat bailed out. But just quickly, your view on how the Fed has acted and the interesting chats that has been happening in the Senate about the stimulus proposals that are trying to be put through, and also the comments that how they learned from their actions during the GFC.
I go back to my statement. It's going to be shock and awe.
Right.
And that's what it's going to be. It's going to be anything and everything. They're going to kitchen sink this. They're going to throw everything at this. My views of what's happening in the Senate is classic politics. I mean, everybody wants to extract their pound of pork. This example of what's happening now shows, in my view, no lessons learned from the great financial crisis. If you read the bailout package in the great financial crisis in the United States, we had arrowhead preservation specified in the bailout bill in West Virginia. We had new racetracks being supported and built in North Carolina. We had snowmaking equipment in Minnesota. I don't know if you've ever been to Minnesota. I don't really need snowmaking equipment. It was for some ski hill, and it's complete insanity. And what's happening now is if there's money being given away, every senator and congressman wants to go back to their community as they go through the next election cycle and say, "Look what I got for you," and that's what's happening. And it's a travesty.
And so then coming back to your comments about the revolving credit and corporates being able to extend their lives, is that what you were saying? Did I catch that right? And also, the Fed announcement that they will begin buying corporate bonds.
You ask the first part of the question again. Something crashed in the background. So we'll ask the question again. Sorry, I didn't hear the question. Start over.
So your statement just now about people going on the revolving credit and looking to extend out their debt, and it being signed. So is this extending the life of some businesses that perhaps shouldn't carry on? Because you have been talking for a while about how the wall of credit that's been built up.
I don't think that's going to happen at all. I think that sorry, let's talk to Brian. Go ahead, Brian. You take this.
Yeah, no, that's not what I was alluding to at all. I would describe these as very strong companies in some cases, A-rated, that are just doing this as a prudent measure to ensure that they have cash around to, sort of weather whatever this lack of revenue is for a number of months, whether it's a month or 3 months or 6 months. I think that's just a sensible thing to do. And you've seen that around the U.S. and probably around the world, people raising cash just because, they really don't know, what the revenue picture looks like for the next 6 months.
Right. And your question speaks to more to those zombie companies I've addressed in the past, the extend and pretend, that exist, for many of these companies. I think many of those companies are done. I mean, I think this is the prick to that corporate debt bubble, that I talked about back in January of 19, where I wrote that piece that you can find on our website, Risk is Where You're Not Looking. I wrote, which was perfectly timed for a great year in stocks and bonds in 2019.
And the Fed has announced that they'll start buying some of these corporate bonds. Again, how will this have an impact on your thesis, and will it push things further out?
Well,
go ahead.
Sorry. At this point, there was a time last week where the credit market in the U.S. really locked up, and I'll call it clearly solvent companies and clearly solvent bonds were without a bid or without any liquidity. And I think the Fed's move to step in is going to calm and reverse a lot of that and allow that to be a functioning market. I think one of the things that's important to realize about the U.S. capital markets that's different from a lot of the rest of the world is that most of the debt financing is bond market financing. It's not bank financing. And that has to do with the history of state constrained banking here. and so it's an important function for companies to be able to, access the bond market here, and the central bank can't effectuate that directly just through the banks. It needs to do that through the capital markets. ECB is doing it also, but in Europe, the banks themselves are responsible for more and more of the credit provisioning. Both here and in Europe, the banks are much better financed in terms of capital ratios and liquidity buffers than they were in the financial crisis. And to date, we haven't seen or heard any problems in the banking system in terms of liquidity or credit losses. Now, there will certainly be a big default and credit cycle that comes out of this, but that sort of will play out over time as the economy normalizes, and those businesses that are, as Steve alluded to, not going to make it, don't make it.
And again, in your recent note, you stated about how, okay, spreads have pushed out somewhat within the high yield sector, but given where the oil price has moved to and the prominence of the energy sector within the US high yield market, it hasn't gone as far as you perhaps would have thought.
Yeah, I'd make a couple of comments. I mean, as of 2 weeks ago, right? What week are we in? Yeah, as of 2 weeks ago, the credit market really had not done much in the U.S. in terms of widening out broadly. Last week, things widened out dramatically. And I think that the area of the credit market that is most interesting is probably higher quality companies that are, again, clearly solvent, but have seen bonds trade from over par to, call it, 80 cents or something like that. The deeper restructuring-oriented businesses with challenges are not something that's, I think, broadly interesting to us at this point. The sector there that really has sold off dramatically, and I think rightly so, because the fundamentals have deteriorated so much, is the energy sector, as you alluded to, and there, we have bought one bond, but not a big focus yet.
I mean, it's tiny. We have hardly any exposure to energy going into this, and so hardly any exposure to energy going into this, and we'll have hardly any exposure to energy, I guess, coming out of this. The energy exposure, that does not exist in the portfolio for many years is really a function of these businesses have been low return on capital businesses, poor capital allocators, and we've been too dependent upon betting on the price of the commodity. If those things were not true, then we would be more interested. So if we found a company that was a good capital allocator, good returns on capital at what is a unsustainably low commodity price in our view, then we'd be interested in getting involved. But we do not want to be in a position of having to make a bet that a company is going to go and shepherd our capital well, and we have to count on oil being $60 a barrel. That's just not something we're going to do.
Okay, thank you.
And our energy exposure is really only on the debt side, and it is primarily in a energy service company that provides engineering and construction services to the industry.
Yeah, it is energy adjacent rather than energy producer.
Okay, so can we move on to the equity markets now, and just your view on have they gone far enough to make them attractive? Obviously, they're still in fair value territory, even though we've seen significant falls.
I think it depends on the company and the industry. I think that the market as a whole, we're just back to December 2018 levels. They're not lower than that. So you're at this place where, again, it's a market of stocks. Each company in the industries, been acting quite differently. And the travel industry has obviously been decimated in that. They were much lower than they were December of 18. So I think that, that some of the businesses that have a lot of torque to them, they're going to snap back, are very, very cheap. It's a question, as to how quickly that will happen. It's interesting because of these rising debt levels that occurred. It's not like you're sitting in a position as you were in previous cycles, at least in my experience, and Brian may have a different view on this than myself. We've not actually talked about this, but companies on average are just more leveraged than they have been in the past. which changes the nature of how these equities are going to perform. The finding a higher quality, great business with a great balance sheet, those businesses are down in price, certainly, but it's not like they're at is what we would call like a gimme price yet. It's not like it's not a riskless trade. They're good businesses, and I think you're going to do fine over time, but it's not that your IRR is going to be so terrific given how they're currently priced. So I think in that regard, there could be another leg down at some point, but it may never happen. Brian, do you want to add to that?
I mean, what I would add to that is that, the consumer staples, maybe with the exception of ABI, which has a fair bit of leverage, the consumer staples all still trade at circa 20 times and, teens multiples of EBITDA. The businesses that have sold off are sort of the ones Steve's alluded to, and ones with a hint of cyclicality and or with a balance sheet that is, I think would certainly be considered prudent in any reasonable economic downturn or recession, but may cause one a little bit of stress if you look at a period of 6 months or something with no revenue. And it's important to point out 6 months of no revenue is in no way our base case, but it's something that you need to at least think through when you're looking at some of the more hard hit companies that are certainly attractive on a basis of a normalized earnings power.
And you were defensively positioned with about 60% held in risk assets at the end of February. This was largely a function of the lack of opportunities offering attractive risk return profile rather than you foreseeing this catalyst that we've seen. And what about now then? Are you seeing opportunities to put some of that money to work?
Yeah, we are seeing some opportunities. We've actually taken this opportunity to high grade the portfolio. We've actually have made a number of different purchases. I mean, the challenges in talking about the individual names is we're in the middle of doing them, and the SEC restricts us as to really talking about them. But yeah, we've found some significant opportunities. We've been very, very actively engaged. Our trading desk has been working overtime as we've been taking the opportunities to add to existing positions that we're very excited about, as well as to add new positions that hadn't previously reached our price targets.
Steve, you said high grading the portfolio there. What do you mean by that?
Well, what I mean by that is if you looked at our exposures going into this, we were very well set up. At 60%, we felt we're for a normal downturn, even a deep downturn, but we weren't set up for, nor were most people, candidly, but that doesn't make us feel any better. That we weren't set up for complete stoppage globally, and in that scenario, the financials become a little bit more reflexive. The nature of what they are and the risk reward changes in that kind of environment. So we've let some of those positions we have not. That you will find us coming out of this. The financials will be less exposure because the risk reward has become different as a result of us not knowing what the outcome will be. It's a smaller part of the portfolio. And the other part of the portfolio, the higher part, is the higher grade part is going to be a much more significant portion of the portfolio. Brian, do you want to add to that?
Yeah, I think what I would add is we've added, I think, about 9 new names over the course of the quarter, many of those in the last 2 weeks. We've exited 3 or 4 names, and then we've added to a number of holdings. And I think the theme of them would be that the things we've added is that they are, high quality, very likely to be, bigger, more important firms in the future, and they have, capital structures that we believe will, in some cases, very strong, cashed up, and in others, believe that they will be able to make it through a period of, 6 months or so of little to no revenue.
And I also want to make the distinction when we talk about financials. I don't want to speak about them so globally because all financials are not created equal. I mean, some of these companies, the financials we own, are will see the other side very, very clearly. and they're just not, they don't have that same kind of balance sheet exposure, and so they have no concerns with companies like Aon, for example, and others. So I just don't want to speak, broadly and say all financials are are not likely to see the other side. It's just some of the risk reward has changed for some of the financials.
Well, on financials then, would you mind touching on AIG, one of the largest holdings in the portfolio, and the progression of that share price and where you see it going from here?
Yeah, I'm going to let Brian take that, but I'm going to say it very simply and say, look, I think it's just largely a function of forced selling and liquidations and fear and panic, is what I'm going to come back to. But that's my short conclusion.
Yeah, maybe a little bit longer conclusion. AIG is somewhat surprising in terms of the price performance. So it's just to refresh everyone, it's a global insurance company that has a combination of a life in business and then a traditional P&C business. And I think that life businesses, just from a trading perspective, have been hit much harder than P&C businesses. And AIG, for whatever reason, has traded worse than traded worse than the life businesses. So it's sort of underperformed the, most exposed part of itself, which is a bit odd. In terms of insurable losses from this crisis, the understanding is that the vast majority of business interruption policies do not cover pandemic, and so the analysts and industry do not expect this to be a large insurable loss event. People would think about it in terms of an earnings hit, not a capital hit. There is some outside risk that courts will try to reinterpret contracts on the back of this, but at this point, the largest loss in the industry expected from events to date are the cancellation of the Olympics, and that's the policy that the broadcasters would have for their risk of having made the financial commitment to the Olympics that aren't going to happen this year. Now, if you move over to the life side, there's a couple of things that are a concern of investors and life insurance companies. I think the most relevant one, there's two. One is low rates, and the other one is credit risk in the investment portfolio. AIG has a much high-graded investment portfolio from times gone by. They do have market exposure, though, in it, and certainly the bonds on a mark-to-market basis are down. I think you heard us mention earlier that the majority of those bonds on a mark-to-market basis, if we get away from the oil and gas industry where they don't have an excess exposure, we would expect to really perform fine over time. These are the par bonds that have traded down, 20 points or whatever it is. I think that's going to prove to be a temporary mark over time, but AIG stock has performed very badly over the last 3 weeks, I'd say, 4 weeks.
And just quickly on the other big sectors or areas that have had an impact on the performance of the portfolio in 2020.
The other big impacts on the portfolio of late?
Yes, please.
I think the other big impact that is worth note, Steve mentioned that anytime you have this degree of uncertainty and potential that if people talk about a depression globally or whatever else, that's going to cause stress on financial firms. The other place that we do have exposure that has been impacted in a very meaningful way is in the aerospace sector. And aerospace supply has been a business that we've liked. It's got very favorable economics in terms of many of the suppliers are sole source. There's long aftermarket to it. Air seat miles have grown every year around the world, essentially forever. Even during recessions, they grow. So this is a situation that was not contemplated. We were somewhat nervous about there being a new build cycle. So, we did not own the Boeings and the Airbuses, but we did not own a portfolio in terms of or names on the aerospace side that contemplated kind of flight reduction going down 80-90% or whatever it's going to end up going down for a quarter year. It's interesting, as Steve mentioned. I think we sort of deeply believe that people will fly, go to restaurants and everything else again, but that is a sector that's having an extreme crunch for cash, and will probably have a lower demand profile a year from now or 2 years from now even than we would have thought of 3 weeks ago. And the real reason for that is you're just going to have a need for tremendous balance sheet repair among the airlines, and I think that there's going to be a time period where there's just less flight activity, even as an economy starts to go back to normal. So that air seat mile growth algorithm that we were investing behind is probably disrupted for a couple of years in light of the virus. But other than that, I wouldn't really call out any sector or specific names that we think are, unduly impacted or altered. Now, we have, among those names that I mentioned, we have bought a couple travel-related companies in there, but those were bought, I'd say, after the pandemic spread, and so the price we think incorporates, a level of subdued activity for a year or two.
So at present, is it fair to say the summary is you're working hard at looking which areas are offering attractive valuation, you are buying opportunities as and when they become available, but you're exercising caution and patience as and when more clarity or certainty or attractive risk reward opportunities become available?
Yeah, I think that is fair to say. I think that it's the combination of, beginning to deploy capital, investing into names, as we said, are high grading, and then, frankly, hoping for, some amount of sell-off in sort of the more stable businesses, whether that's software or consumer staples. I think that the volatility has been fairly extreme. I think you have limit down, limit up every other day. And so sometimes you're buying something at a price and it moves quite a bit. And I think we don't feel that we need to get the full position on the first slug right now.
And you, I think you touched on this earlier. You certainly touched on it in your note that you have been adding to some Asian stocks that you were already buying.
Yes, we started doing that earlier in the quarter and have continued to do that in the last couple of weeks.
Okay. Well, I'd like to wrap it up now, but just one last question. I'm not sure if you're aware, but we've had an announcement last night from the president that we will be going into a form of lockdown on Thursday night. I know that you've had a similar situation in LA for a period of time so far. Would you mind just commenting that and how that's affecting your lives or the lives of those around you, and any changes it's making?
Look, it affects everybody a little differently because it just depends on the kind of whether you're living with kids or without kids, for example, right? One of our partners, his wife is pregnant and will have to go deliver. He was worried about delivering in a baby in a hospital in fairly short order where there's COVID. They got a 2-year-old running around making lots of noise. I'm fortunate my kids are older, a little bit more self-contained, but they're engaged in online schooling. It's going to begin in 25 minutes here in Los Angeles. But it is certainly, disconcerting, and it requires, for all of us to be patient and understanding, in our home, certainly. But I think that I'm very confident that COVID is not going to take me down, either a business professionally or me personally from a health perspective. On the other hand, living, I think that she may kill me, but that's a whole different conversation.
Thanks, Steve. And then finally, are there any other final comments that you both like to, or either of you would like to make for the audience?
We think that we think that the portfolio is well positioned, for a recovery. We look, we got to be careful what you wish for, right? I mean, we're still not fully invested, so we still have plenty of liquidity. I would say our exposures, we're taking this opportunity, as we said, to high grade. You will certainly see, some favorable marks given what's happened in the market today. As one should expect in one. But I don't want to go and hang our hats on what's happening today. This is a knee-jerk reaction, and the market could be down tomorrow for me, or it could be up tomorrow. There's going to be a lot more bad news that we're all going to be facing, here in the U.S. with respect over the coming weeks with respect to the number of people affected. Now, that's not going to shouldn't be any great surprise. It's as we get tests out, these people are already affected. So, go ahead.
Oh, sorry. I thought.
No, go ahead.
Oh, I was going to say the one thing that we are thinking about, and I think it's a very challenging balancing act. But if one were to imagine that the security markets, in whatever your home country or across the world, were to close for 6 months and to open up again at the end of this crisis, what would you want to own when that day opens back up? And what would you have wanted to ridden through with? And I think that, when we use that as a framework, I think we're pretty confident. I shouldn't say pretty. We're confident that government bonds and cash are not the place we would want to be sitting in for the next 4 or 5 years. And so, while we need to be thoughtful about the names and thoughtful about the sort of dynamic of the day-to-day in the market, we do think it's important to end up with a more heavily weighted equity portfolio as we go through this.
Okay, thank you very much. So on that note then, Stephen, Brian, thank you very much for spending the time with us this afternoon and sharing your thoughts with the audience. To the audience, thank you all very much for joining this afternoon, and I hope you found the information shared with Brian and Steve interesting. I know I did. Just so you know, we have another call tomorrow with Andrew Headley from our Global Equity Fund at 4:30 p.m. South African time. We have Ian Power from Truffle on our Balanced Fund on Thursday, 10 a.m. in the morning, and then Omri Thomas for our Opportunity Fund from ABAX at 10 a.m. on Friday morning. I hope you'll all rejoin us then. And once again, have a good afternoon. Thank you very much for joining. And Steve, Brian, thank you very much.
Thank you.
Thank you.